Hi, David Moore with Equity Advantage, 1031exchange.com. And today I'm blessed to have Troy Eckard, CEO, founder, and manager of Eckard Enterprises. We're going to talk all things oil and gas. And we're going to do it from two contexts, actually. And we want to talk about it from the application for 1031 and why you'd be looking at it. Also, for our IRA 401k investors, if you're looking to diversify outside of Wall Street and outside of maybe your real estate holdings, this is another opportunity for you today. So Troy, normally I do sort of an intro, but I think, I always love talking with you, and I think you're going to do a much better job of introducing yourself. And so why don't you tell us a little bit about you and how you got into this space?
Well, it's been a 36-year career. Started off studying economics and finance in college, and then after living in a travel trailer with more holes in it than a radiator, starving to death, I was convinced to move to Dallas to get my securities license and become a financial advisor and broker for high net worth investors who wanted to own oil and gas in their portfolio directly. They were looking for tax write-offs, diversity, alternative investments. So that's how I started. Ended up starting my own investment firm, licensed firm in 1991, and then decided the best way to help my investors was to start creating the actual asset classes themselves. And so we started putting together our own ventures, and that has led to a storied career that covers 3.5 decades. And it's been very good. It's been very interesting, and it's allowed me to work with literally thousands of high net worth investors from all facets of life, which gives me a pretty broad knowledge, not only in energy, but across multiple different investment sectors.
So, it's interesting. My father-in-law was a very charitable guy, and I always asked him how he get involved with different things. And he said, well, it's easy. It's go and do things where you can make a difference. So it's interesting. Your story, my brother and I grew up in the Bay Area and moved to Oregon in 1990s, invest in real estate. And, we came here with virtually nothing. I think the first rental house we bought, we're, doing modified flips. We paid $23,000 for it. So that was a different world in those days. And it's just so crazy how things have changed. But, I think that if you look at your story and what's happened, it's America, right? I mean, that's the deal. You look at it, you say, okay, hey, what can I do? And at least in the old days, we go and do it, and a lot of times people ask me, well, how'd you get into this or that? And I jokingly say, well, I didn't know any better, right? So, yeah. So it's like, don't tell me what I can't do. It's just going to, force me into trying to make something happen. So, with this whole space, Troy, I mean, obviously people, come to me primarily if we're looking at the 1031 side of it. They're always looking at getting out of something they don't want and getting into what they do want. And the retirement side of our business is the same way with IRAs and 401k plans. They're coming to us from a world of Wall Street, and they're now looking to do other things with their money. And I think that what you've got is one of those other things to do, and it's just further diversification. Any financial advisor is going to say the best thing you can do is diversify, right? So, why would somebody, look at oil and gas? Has this option been available for a long time? And if we're looking at it from the context of investing via 1031 or via retirement accounts, what might be the differences in those two products, or how it happens?
Well, let's tackle the conversation from the very basics. I'm a very blunt person, and since I've been doing this for so long, I've had the good fortune of working with very sophisticated investors over the year who've watched these cycles in stocks and bonds and real estate and oil. And the number one dilemma with oil and gas, it is a alternative investment in which resource and data or information is next to impossible. So you don't get to go find an index. You can't find 1,000 financial planners. You can't find anybody who really can say, here's how it works. And so what it has lent itself to be, it's kind of a scary sector, because when people don't get information, they're either paralyzed by fear, they avoid it because of fear, or they dive in head first, hoping they get out of the deep well they've dug. And so what I've noticed is that, the incentives that drive private investors into oil and gas historically have been major tax write-offs, because that's a big thing for high income earners. And it's the greed button. It's the, you drill a well, you can make 10 to 1 on your money. Well, that sounds good, but there's something I notice when I go to Vegas. All the high stake tables are empty. It says reserved. There's never anybody at them, because either they're not coming down to gamble, or when they do come down, they don't last very long. So oil and gas has had that image. And the reality of it is the oil and gas industry is broken into three sectors. It's Upstream, which means everything from seismic shoots to leasing and mineral to actual drilling. Midstream means from the time it comes out of the wellhead and is headed to the refinery. So it's all the transportation, trucking, pipelines, processing. And then downstream is from the refinery to the end user. So those three sectors all have very unique components, no different than, let's say, industrial, multifamily, or residential and real estate. I have always focused on the upstream side, seismic, exploration, minerals, and then I have been very involved in the midstream side of the business. So because of that focus, it makes it a little easier for me to determine which asset within those classes makes the most sense and can be available or satisfy a 1031, might be appropriate for an IRA or a 401k. And the truth of the matter is, it's like any investment space. It is going to be totally based upon the management, the who. The who factor is probably 95% of your success or failure. I don't care what investment you're in. So the who is the most important part.
Yes. So interesting. You talked about the reason to go do something, the write-offs, and that's a lot of what I've seen in that space through the years. And if you look at, for example, opportunity zones and the whole deal, it's a development play. It's somewhere to go, right? But what good is tax deferral if the development doesn't work and you're married to this thing for 10 years? So, since you brushed on it and you've got these different streams there, but if you look at, let's just from the 1031 context, what exactly, what products or assets do you feel are number one, what are available to a 1031 investor, and which ones are best in your opinion and why?
Well, first off, because it's a 1031, I'm trying to move a safe asset, traditional real estate, into a like kind exchange asset, which is going to be real estate. In the oil and gas industry, real estate is going to be traditionally ownership in a well, producing well, or it's going to be into a mineral interest. You can get into a midstream pipeline interest, but most of those are done under LLCs or some kind of structured entity, which doesn't qualify for a 1031. So because of that, you're really limited to buying producing properties, oil and gas wells that are online today, or mineral interest, which the IRS has declared as a real estate. So you got an IRS ruling that makes it a 1031 tax exchange qualified asset, but that's really the only two. Now, personally, because I've been in the battle zone, I've been on the battlefield for 36 years, I personally would not buy with a 1031 into producing oil and gas wells, because you're buying a reservoir that is limited to a single well that is being drained every day. So it's a depleting asset. And so if I'm trying to build a 1031 exchange value that has some accretive value at the end of that holding period, I want something that's left, not something that's depleted. And the only way I can make more money is strictly off of commodity price. So it's the hope and prayer that commodity prices saves you. That's not a good investment. Yeah. Whereas mineral acquisitions are different. You can actually buy mineral interest under an in producing fields, where maybe it is like a real estate development where somebody finds a anchor tenant. They know there's additional development. They know the first parcel of land was sold for $5 a square foot, but they know subsequently those additional parcels are going to sell for $15, $20, $30 a square foot. So minerals give you that 1031 exchange, but they give you the accretive value along with the cash flow. So for me, both qualify. I prefer to go to minerals versus the working interest.
So if you're looking at the mineral interest, you're looking at an opportunity for appreciation.
Yeah.
But as far as during the time, the life of your investment in it, it's going to be kicking off some yield as well.
Yeah, absolutely. Well, it depends. I mean, let's face it, it's kind of like being a real estate developer. I can go north of town 20 miles and buy raw land. It's not annexed. It's got no value. There's no entitlements, and I'm paying $1,000, $1,500 an acre. Or I can get right up next to the closest loop and I can be paying, $40,000, $50,000 an acre, but I have a higher probability of shortening the time frame, which is one of those risk elements, right? So take the backdrop of where you're sitting. The office complex you're in, if that were around a oil and gas basin like Dallas-Fort Worth, sits on top of the Barnett Shale. So you could sit there and own that building and own the surface and you created it, but a separate owner can actually own everything below you, which is the mineral rights. And so you could sit there and make a great deal of money on those vertical construction projects, but below you might be oil and gas reservoirs that are being drilled through horizontal drilling. That is the key. The key is buying in highly developed areas from day one that are already proven, that already have cash flow from the day you buy it, with a lot of increased development expected as a result of the previous well's history. So yeah, you can buy raw speculative minerals, I wouldn't. Or you can buy underneath, high-end complexes like we're talking about.
So you're looking at a vertical subdivision, basically, or breaks. I mean, a lot of times in real estate, we're looking at a situation where maybe we've got long-term leases of the improvements on a land deal, and and that's one of those situations I don't see that often. I don't understand really why, because if you want a nice passive investment, why not own the dirt underneath the project? And that just doesn't happen. Or we see air rights sometimes too in larger cities, just control of that. But you're just talking about that underneath that actual surface element. We've got a whole nother piece there. And I got to tell you, so one of my grandfathers was a speculative guy, and he bought and sold these incredible properties, but he never held them long enough I think he had like a couple lots on the 17-mile drive in Pebble Beach, and bought them, sold them, didn't make much. Instead of buying in Palm Springs, he bought in 29 Palms. But what he did in 29 Palms is he actually owned the mineral rights underneath. And so we still get checks. This is 60 years later, probably, from some oil company. And to your point, if it's dry, it's dry. So these checks are only like $30, $60 every year. It's sort of a joke, but it's interesting. I don't think people think about that ability to slice and dice things vertically. It's always looked at that horizontal type of subdivision thing, and you're just talking about breaking the different elements out in your space.
Yeah, so let's use mineral rights and the difference between maybe what you experienced in your mineral rights to playing golf. In the old days, you had the green, which was the defined area where you might have oil and gas reserves, because a geologist or a geophysicist determined there was some kind of structural trap, had oil and gas buried there, and you're going to go try to drill a vertical well like the hole you put your ball in golf, right? Yeah. And so it's literally like a hole in one, but you might have a little bit of variance. If you get close, you get, maybe not as good a well. Well, the reason why it was not a good investment, not only to drill, but also to own minerals, because if that well were dry, it could essentially condemn that entire green from being viable until somebody was willing to take a risk to offset a dry hole. But yeah, that's happened. I mean, they move over to 6 inches and they are 60 feet and they make a better well. That made it very risky. So it wasn't applicable, right? Now the oil and gas industry is like the entire fairway. So from the minute you go to the tee box and you try to get to that green, the oil and gas shale plays are wide, they're long. You literally, unless you're just horrible, you're going to stay somewhere in the fairway. And what that means is I can buy minerals along that entire fairway. Now it really matters as far as who I'm going to encourage. Can I encourage somebody to drill? Well, our company takes that out of the equation. We don't look for a maybe or when can we attract somebody to drill. We go find where the ball has already been placed, where somebody's already made a stroke. We then buy the minerals in and under and around those producing wells. So we know we have cash flow from day one. We've already de-risked the asset of the mineral from that standpoint. Did not have that technology 10 years ago, David. We didn't. We had this country was running out of oil and gas in 2008. We're down to the lowest level of production since 1941. Oil prices skyrocketed to $145 a barrel. So today, innovation, technology, software, hardware, the same stuff we use to send spacecraft to Mars, same stuff we have these driverless cars, is now literally computer chips behind the drill bit 2 to 4 miles to the ground, using triangulation with satellites to tell that drill bit how to stay within inches of being within that target zone. And then you carry that through the entire process. So now the oil and gas industry in my 36-year career has gone from a witching rod, hoping you find it, to now you got guys looking like they're playing video games inside of these drilling rigs where they're using hand controls to untwist pipe and to control it. You've got 10, 15 people on computers in Houston and Denver and Dallas looking at the same wellbore 24 hours a day, with engineers and geologists looking at it literally 24/7. We never had that before.
Wow. So I'm sitting there listening. I like the golf analogy. I think about, the person sitting 300 yards away on the tee trying to hit the ball where they want it to be. And for some reason, the picture of Odd Job in one of the old James Bond movies, with the ball slipping out of the pen right where you want it, right? So you're given that ability to the normal Joe, and you're minimizing the risk element.
I always look at things, David, from the why factor. Like, why would someone sell minerals underneath big producing wells or right in the middle of a fairway? Well, it's no different than why somebody would sell a Class A apartment or a really beautiful piece of property, or maybe a piece of raw land you knew is going to be developed. It depends on what they bought it for. It depends on what their intentions are. It depends on their financial stress. Are they needing some liquidity to create an opportunity somewhere else? So what we find is that when we're out buying minerals, we may have a 4 or 5 generational family that owns a 150 to 300 acre farm in Oklahoma. They are trying to buy a new tractor. They're trying to put, grandma into a nursing home, thousands of reasons. And then they look at the property on the surface and say, we can't afford to sell the ranch or the farm. It's been the family for 100 years. So what do we have as an asset that is liquid? Well, we can go sell 20 or 30 acres of our 150 acres into a market where buyers now realize that they can buy those minerals with a 98% certainty that wells that are drilled will be successful. So you could have bought minerals for $100 or $200 an acre 20 years ago. Now you're paying $10, $15, $20,000 an acre. In West Texas, David, they're paying as much as $75,000 to $150,000 an acre for minerals in the ground. That's just insane.
Wow.
I don't do that because I don't think the numbers work, but that's what. So you own a piece of property in West Texas. You can't get 2 goats to grow on an acre, right? They couldn't survive. And so your land's worth $1,500, but the minerals on the ground are worth $75,000 to $100,000 acres. So those guys who bought the scrub brush are laughing all the way back going, you thought I was an idiot. No, you turned out to be a genius,
That's amazing. That's amazing. Yeah. So Troy, I mean, what we're talking about really, it's tangible assets. So we all hear the ads on the radio and see the ads on TV, people selling gold, silver, everything, real estate. I'm a real estate guy. Real estate, feels like the ultimate tangible asset. But if somebody comes to me, most of the people that come to me on the retirement side of our business through IRA Advantage, they're wanting to diversify outside Wall Street. And a lot of them are wanting hard assets, tangible assets. And I always joke that for some reason, the oldest investments known to mankind are considered alternative investments instead of real investments. So I look at the stuff we talk about and deal with as real investments, not alternative investments.
Yeah.
But as far as if somebody comes to you and they're buying into this stuff, a lot of our clients have debt, and one of the biggest fallacies in 1031 is we got to replace debt in an exchange, which is, if people watch my seminars, that's bogus. It's totally wrong. We can always offset, a reduction in debt with cash. So if they're coming into you, do they have, is a debt component available, or would they just be offsetting with cash? And then as far as the nature of the investment, if one of the things great about real estate is we're buying an asset, somebody else is making payments for you typically. So you're going to have cash flow. If it's an improved property, you got depreciation, interest deduction, so on and so forth. Obviously, if it's not leveraged, we're not going to have any interest deductions. But as far as you mentioned, like the equipment on it, are the investors, what are they getting exactly, and what does that ROI ultimately, what is it an aggregate of?
Well, let's start off with the comparison between a real estate landlord and a mineral owner.
Yes.
So in real estate, I've got the building that I bought. I'm the landlord. I probably have leveraged it. I got a note. I've got equity. I'm looking at a pro forma net operating income, underlying expenses. I'm trying to determine what I can rent for to get that yield. Minerals are a little bit different. When you own mineral rights, your tenants are major billion-dollar oil companies, Exxon, Chevron, Marathon. The way it works in the oil and gas industry is a typical mineral lease is for 3 years, but you get paid all that money up front. You don't have any worry about somebody defaulting or rent forbearance, all that nonsense. They pay you up front for 3 years. Within that 3 years, in order to maintain the rights to develop your minerals, they must drill a well. They must have some kind of execution on the development side. So let's say Marathon leases my minerals. They pay me $2,000 an acre. What they also give me, though, is a royalty percentage. They say to the mineral owner, we're going to pay you $2,000 an acre. We're going to give you 18.75 up to 25% retained revenue sharing, called a royalty, where you have zero liability, zero capital costs, zero holding costs. You simply get 18.75 up to 25% of all future income free. I love that.
Yeah.
So once that lease document's signed in the oil and gas real estate space, that tenant, that oil company, assumes 100% of the liability for all costs, taxes, improvements, liability, drilling. You pay nothing.
So it's just like a triple net lease, basically.
It's even better than triple net, because I don't care what they do. When oil prices plummeted last year, they were losing money every month. I just got my check every month. Here's another big factor we've learned over the last 6 months, which is really come to a real recognition. A lot of these oil companies had to go out and hedge their oil. They were forced by their banks. Listen, you got to protect your downside. You need to go sell and commit your volumes at $50 a barrel, because guess what? We want to make sure your collateral is good. It'd be kind of like you having an apartment complex and everybody moves out one day. You don't have any income to support that. Your bank says you need more equity. Well, in oil, they make them hedge their oil ahead of time. A lot of our big producers hedge their oil at $50 a barrel. We got our checks this month. We got paid $72 a barrel. They got paid 50 because we're not hedged. Do you know why? They don't own our oil. In a mineral position, you are at the headwaters. You have first payment, not subject to bankruptcy, not subject to bills, zero liability. When the oil company receives the money each month from the buyer of the oil and gas, they take that royalty interest, set it into a royalty account, and they have to pay their bills with whatever's left, because that oil sold is not theirs. So back to your question, when you talk about the equipment and stuff, I don't care. What you don't get is a tax write-off. What you do get is the equivalent of depreciation. 15% of my income every year off my minerals, I don't pay taxes on. I like that. The other thing I get is I get checks every month, and it's simply a check. I never have a bill. I never have written a check out in 36 years on any mineral I own. It's just free income. So it's about the most passive asset you'll ever own. Wow. The additional thing that's important is that you have three ways of making money on that mineral. You have the actual cost basis. So it's a one-time acquisition. There's no debt involved. Acreage might be 11, 12, 15,000 acres. You write a check, you pay for it, no additional capital costs, but now you have your basis in that investment. I'm expecting the value of that to go up, because what's happening every time they drill a well, I'm now proving up down in that safety deposit box called a reservoir. I've got a whole lot of reserves that are worth a lot of money. And somebody's going to pay me for those reserves, even if they slightly discount it. I now have proven reserves. So that's value. I've got cash flow every single month for whatever oil and gas is sold. So when you think about moving into a 1031, I'm going out of, let's say, a apartment complex. I want to replace that income. Maybe I don't want to be re-levered again with some debt, but I just want to go sit on the beach. I want money coming in. I'll take that $2 million and do a 1031 into minerals. In about 180 days, within 6 months, you start getting your first check. And those checks continue to come, because once we file the deed and we let the oil company know, hey, we're the new owner, and the starting date was September 1st, every drop of oil and every molecule of gas, I don't care if it's 100 wells or 1 wells. And honestly, David, we don't care if they drill 1,000 wells. I want a pin cushion. My reserves are in the ground, and you're going to go develop them for free, and I get my share. Drill them all tomorrow and suck it out with a big vacuum cleaner. I don't care. I want it all. The cool part about this is, if you want to think about it from an investment perspective, is once the revenue starts in 6 months, I literally can get revenue checks for 25 to 50 years, because the new wells being drilled in these shale basins have 25 to 50 year economic life. I still get minerals, but you've gotten minerals for 60 years, right? Now, all of a sudden, you get minerals on these brand new wells, but the wells probably your dad or granddad drilled. If they came to 50 to 100 barrels a day, that was a big, big well. These wells are coming in 1,000, 1,500 barrels a day. They're making 40, 50,000 barrels a month.
Wow. And
so the comparison is just, it'd be like you trying to take your 1970s computer and run with today's app. It wouldn't even start, right? That's the difference. Exactly. In well. So the United States has solved its energy problem. Now, here's the fun part for your investors and your listeners, right? So we went from a mineral market that was like that golf example. I'm trying to find the green in the hole. Now, all of a sudden, we've got 30 states in the United States with oil and gas basins, which is the equivalent of a buried Grand Canyon. We know where it's at. They're 300 miles long, 200 miles wide. The geologists know where they're at. I no longer have to count on that geologist to tell me where to drill. What I really want is a manufacturing process with really good engineers that continue to improve the process, which is what they've done. So now the oil and gas mineral market has moved from being very hard to get into, mostly for institutional buyers, rare to find, to now it's a $500 billion market. We've now been in Oklahoma for 3 years. We have bought minerals for 3 years straight, 0 dry holes, 511 producing wells. Those 511 wells will probably end up being closer to 2,500 to 3,000 wells, because the oil is so saturated, they'll have to drill a second, a third, a fourth, a fifth, a 10th well to get it out.
Yeah.
Now this has become something that a high net worth investor, whether it be through an IRA, 401k, or 1031, or a traditional investment account, now they can get their brain around moving money out of stocks they can follow every day, or bonds, or real estate. Now they can get their head around this actually can become a cornerstone or part of my portfolio. Whereas before it was Las Vegas. Yeah, throw your money up, hope for the best. Well, we're getting too old for that stuff. It's too hard to bounce and get up again.
Well, yeah, we actually, well, won't get into it on this thing, but yeah, we've had investors with IRAs do some pretty crazy things because truly self-directed accounts, the guardrails are off. So anyway, it's a crazy time. So if we look at your option there and people going into it, obviously. There's a lot of refugees from doors, right? I mean, if you're looking at diversified income, a lot of the stuff through the last year and a half and COVID and all this, it's really changed stuff, especially if you're in a state where rent control is so dominant. And, you're sitting there holding an empty bag if you're the property owner and the tenants are getting everything. And so the natural tendency is for a lot of commercial brokers say, oh, well, hey, just go buy a triple net big box single tenant building, which you've probably owned them. I've owned them. They're great while they work. When they go dark, it's a big nightmare, right? So there's definitely risk there. And that's why the doors are popular. But with doors with multifamily stuff right now, that's a problem. You got mini storage, it's a different deal. But those are, the DST space is selling those things. This is an option for people, definitely. And if we look at the risk profiles of that big box, like I said, it goes dark, you got a big problem. In your space, what are the potential downsides? What should people be looking for? Or this is what you do. You're an expert in it. Somebody comes to you. I guess the other question I had is with these drilling operations, people there, are you typically in a situation where you've got bidding wars going between these different companies doing that, or is there a handful of companies in that space? And then I guess one last sort of question in the risk profile is, we're in a clown world right now. I mean, so for future context, this is September of 2021, right? So we've got major tax reform issues out there, all kinds of craziness. In the last 8 months, we've had lots of things change over. Pipelines get shut down for no reason, and yet they're okayed for other countries. But, so what comments might you have for the audience if people are sort of concerned with maybe risk, or, we've talked about the upsides. What's the potential downsides in this space?
Well, let's start with the obvious that whoever you invest with in the oil and gas energy space, it's the who factor. You better find out who they are. I don't know how many clients I've helped rescue the last 36 years where I've got them even this year saying I invested, $500,000 with ABC Oil Company, and I go, okay, well, I haven't got a check. They won't respond. I Google them and it shows the guy's a felon. He's got 5 cease and desist. I'm like, did you even Google him? Well, no, he seemed like a nice guy. So a country twang means honest. I'll just start talking more country. So the first thing I would tell your audience is do not lose sight of the basic fundamentals of due diligence. It's the who factor, right? If you get comfortable and the who factor works and you've done your background check, well, the next thing is the what. And the what has to be what's best for you. Don't get talked into a drilling deal if your income's not high enough to offset the tax write-off. And by the way, when somebody tells you I'm going to get you a tax write-off, if you look by the definition from the IRS, it means I'm going to lose your money. So it should be considered a tax deferment. Yeah. And the reason I say that is that if I invest in a well and I think it's going to work, I'm simply having you take today's tax obligation, defer it long enough down the path that the oil and gas well makes back your money, makes a profit. So I'm all about tax deferment versus tax deduction. But when you look at the real risk, the risk is as follows. There's a lot of private equity groups who came out in 2015 after the first Saudi Arabia attack on our industry by flooding the market. And they threw hundreds of millions and billions of dollars at buying minerals. And their strategy was, if there's 4 wells in front of you being drilled, buy anything in front of, aside, under, and in front of. Just buy everything you can. Buy 50,000 acres. And their theory is always the same. We'll buy 100,000 acres, hoping that 10,000 acres works. Well, the problem with that is it doesn't work, because the oil and gas industry is a very intricate industry between the 3 sectors that I talked about. And the truth of the matter is the risk is you buy minerals that never get activated. There are literally like 2.3 billion acres in the United States, of which maybe 3% hold oil and gas underneath it that will be drilled. So what you must do is realize, just like in real estate, you can go buy real estate anywhere you want in this country, and it can be cheap as dirt, right? I mean, cheap, $100 an acre, but it may never be worth more than $100 an acre ever in your lifetime or 5 generations. So the key is the where, the what, the who, and then at the end of the day, the real risk is what your perception is of your listeners. The perception is we got this Green Deal coming around, and we got an administration that's anti-fossil fuels. And this Green Deal, everybody's going to be driving electric cars, and they're going to be hugging trees, and we're all going to be naked going to meetings, and we're going to do Zoom. The truth of the matter is that what's going to happen, because you can see it today, we are already back to pre-COVID levels of consumption. Nobody's saving one drop of oil and gas since last year. In fact, it's rising exponentially. We've already consumed the 1.2 billion barrels that we had in oversupply from last year. That's gone. Now what we have is an oil and gas industry that's about 50% of its capacity of last year, but yet our customers are increasing their demand. There's not anything anyone can do economically that's going to stop the price of oil from clearing $100 a barrel, and natural gas is at a 10-year high. Here's the real problem. The real problem is every time this administration opens his mouth, he gives me $5 a barrel increase in value. I probably should have voted for him, but I couldn't do that to my dad. And the truth is, and this is my opinion, David, this is what I think we're dealing with. We're dealing with an administration that wants alternative energy resources to be used that are not economical. So what they're doing is they're going to help drive the price of oil up to $125 a barrel or higher. So it makes solar, wind, hydrogen, other resources look compatible. So that way the consumer can be mad at oil by paying $7 a gallon at the pump. And they start thinking, well, I can just use, solar or wind or hydrogen or whatever else I'm going to use. There is a specific financial directive. Now, I don't care. It makes me happy because at the end of the day, everything on this computer screen in your office and mine, everything we're wearing, the shoes, the carpet, is all made from, transported by, or manufactured by a barrel of oil. That's not going to change. No. So when you look at future growth, this is important for your listeners to understand. Future growth. So today, let's just say we're at one, par of one, meaning energy needed, energy supplied, we're at par. But we know because of population, manufacturing growth, and transportation, energy might be at 1.25 in 20 years, 25% growth in energy consumption. What we do know as an industry is that we're not going to get 100% of that growth because there is going to be choices for alternative energy. What we're seeing is we will maintain what we're producing and consuming today, but we will probably get 60 or 70% of that growth. So where this whole concept, oil and gas, is not going to be used, the oil industry is dead, it's a joke. And that is where a smarter long-term investor like you and I talked about, when you think about buying that 20 acres, 5 miles north of town, going, nobody's going to do anything for about 5 years. But in about 10 years, it's going to go from 5,000 an acre to $10 a square foot. What I see with oil and gas reserves is that we have a big pressure on providing capital to drill. Pipelines aren't being built. Everybody's getting tax deductions removed from oil and gas. In other words, the incentive is to demonetize the oil and gas industry, which means the most valuable asset in the U.S. for energy is owning interest in a producing well. But I don't want to be in that well. I want to be the fat landlord sitting on the beach, and I want to have 500 employees working for me in Oklahoma 24/7 they call pump jacks. I don't want to hear about your complaints or your day off or your vacation. I just want you to keep moving. And that's really what owning mineral rights is. It's a hands-off, passive way to own the most valuable resource in this country, which is a producing oil and gas well. That's what it is.
That's a great explanation and a great story. So as far as buying it, okay, yep. If somebody comes to you and they say, hey, Troy, I want to do this. What do you need from me? What qualifies me to buy? What's the process take? And I guess the other thing, if we're looking at, I would sort of put you in, you're obviously in the passive investment space, and you probably compete, against DSTs, so on and so forth. The biggest issue with DSTs from my client's perspective is typically the holding period and lack of liquidity there. So what comments do you have for the audience? Yeah. So what comments do you have for the audience as
your audience may guess, I was the guy that got suspended the most in high school. I had straight A's, graduated with honors. I was on the football team, played offense, defense, got, all Valley, the whole 9 yards, but I hated being told what to do. So for you to capture my money and put it in something where I can't get out, I don't have any control, I got a management agreement, hey, I don't like that. So the way we do business is we simply allow high net worth investors that are accredited. We only deal with accredited investors. And those accredited investors will look at what we call mini portfolios, between $1 to $3 million portfolios. We take minerals under Exxon and Marathon and different companies, we blend them into one portfolio to give us diversity and meet the economics that we want. We want 10% or higher annualized returns. We're looking at the actual asset. Our anticipation will be worth at least 2 to 5 times higher than it is today by virtue of the reserves that we prove up. So all in all, it's a 5-year kind of time frame that we have in our mind. Cash flow starts in 180 days. But the idea is that we want you to be able to do it in a 1031 as well as a self-directed IRA or 401k or just your traditional account. They're your minerals. And what we provide you is a simple 3-page management agreement, and we don't charge for management. We say, look, you can invest $100,000 into this mini portfolio. You're going to sign a purchase sale agreement. It's going to have an exhibit tell you all the tracts of land that you're going to be participating in for minerals. We're going to file those with the oil company, notifying that we own it. We're then going to send you a copy of those executed deeds for your file. You own them. It's real property. You could call me tomorrow and say, Troy, I don't like the way you come here, your ugly face, assign my minerals out. We'll assign them to you. Now the checks come straight from the oil companies to you. We're only in between you and the oil companies because we got 35, 36 years of expertise to help you manage and make sure you're getting paid the right percentage, et cetera. But what ends up happening is because we're managing it, it allows you to do it as a 1031. It allows you to do it as a 401k and self-directed IRA. And then strategically, our goal has been very well defined because of the pattern I've seen over the last 36 years. We're currently at the tail end of a 3-year aggregation cycle. We've been aggregating. We're at about $75 million worth of minerals we bought in the last 36 months. We believe that that aggregation will continue through next year. And then this first tranche of portfolio will mature as the wells come online, the offsets produce, we'll have that nice income stream. And we believe we'll sell probably 1/3 of our mineral portfolio, your choice. I'm going to proxy, you say yes or no. I'm going to probably sell 1/3 of my portfolio in the first part of 2024 because we believe commodity prices will be in the correct position. We believe the absolute starvation by pensions and high net worth family office will be looking for that yield above inflation. We'll sell 1/3. We think we'll get 2 to 3 times the price minimum. That's going to give us 100% of our money off the table. 2/3 of our minerals are free and clear. We do it in another 5 years. The key to this is that you do not have to participate because you own the minerals themselves. So you got publicly traded mineral companies. You know what they do? They sell you the stock. They tell you they own a bunch of minerals. They pay you a little 5, 6, 7% yield. And then what they do with the excess cash, they buy more minerals. So their stock option, their stock goes up in value. So you're getting one slice of a full pizza. The other thing that happens, you get into some of these like Permian Basin Trust. Well, it's still a public security. When that stock market goes down, it's not going to have particular prisoners it doesn't take with them. Everybody's going to go in the same boat. So the key for us is it's direct real estate, titled. You own a purchase sale, you own an exhibit. You could literally transfer it to your kids with one simple piece of paper. Eckard doesn't charge a fee. What we do is we understand the simplicity of minerals. And after you write a check, you literally don't have to talk to us. You're going to get 13 things a year, 12 distributions of your checks and a 1099. That's it.
But I'm working, so I'm working with you on the acquisition, and then you're managing the asset for me during the investment life.
Correct.
And if I want, so we just talked about the transferability of it. If I needed to get out, what's the process of getting out? Can I get out? Any issues with that?
Anytime you want to. So there are literally thousands of buyers of minerals out there. And of course, it's like real estate. You got some real bottom feeders who try to beat you out of your money.
Yeah.
What will happen though is we have the top engineering firm in Oklahoma hired called Pinnacle Engineering. Oklahoma is our core base. We like it for a multitude of reasons. I refer to Oklahoma, but you can buy them in any one of the states that has oil and gas. But in our case, we've got the #1 engineering firm in Oklahoma. Pinnacle Engineering is our engineering firm. And the way we view it is if you call today and say, look, I have a medical emergency, or my family needs the money, I just decided to invest in something else. We would look at your portfolio. We would ask Pinnacle to do an analysis of where they think it is today. By the way, I don't care what they say it's worth. We know the fair market value. They're simply giving me a fair litmus test of the assets or the minerals you own. So I have a basis of value. And then the first thing that's going to happen is probably my company is going to make you the first offer. And if I can't afford it or it's too big or I don't want to buy it, I'm going to go to my 400 or 500 millionaire high net worth clients and say, we have these minerals. In my experience, it never makes it past me or the 400 partners because the partners selling it, they know what they're doing. The partners buying it know what they want. And everybody wants to continue to accumulate a good thing. Now, let's say that doesn't happen. You say, yeah, I think it's worth more than any of you knuckleheads want to pay for it. Okay, great. And that can be true. We can help you post it on EnergyNet. We can post it on Clearinghouse. There are all kinds of sites you can post it on. And trust me, there's about 22,000 people registered on EnergyNet. and 21,999 do not have a clue which way a drill bit turns. So they will pay you really dumb prices for your minerals, and that's another resource. But the key is getting out is not hard. It's a matter of timing. You can't buy a seed today and try to sell it for twice the price tomorrow. It's still a seed. You got to let these minerals begin to cultivate and develop. Everything we have in our portfolio right now, on our previous portfolios, David, we're averaging about 13.9% average return per year, and we only have a third of our minerals in production. So we are way ahead of our projections, but it's a combination of two things. There is a giant going out of business sale in the oil and gas industry, and has been for almost 2.5, 3 years, since October of 2018. The oil and gas industry imploded. It was long before COVID and Saudi Arabia flooded the market. So what you've got is mineral owners, equipment, leasing, pipelines. They all have going out of business signs on their front door. We just happen to be smart enough after 3.5 decades to see that sign. We dug in, we got our partners behind us, and we're cash buyers. We're still accumulating minerals right now, about 50 cents on the dollar what people paid 2 years ago. We just locked down a $17.5 million mineral package, and we opened it up on Friday. We're over almost 65% funded in 4 days, because the package is 35% cheaper than any minerals we've done in the last 2 years. A major institution had to sell it. They needed to rebalance. We say, we'll take the whole thing, but here's the price. And they said, well, you're the number one mineral buyer in Oklahoma, Troy, and there's nobody standing behind you, so we'll cut a deal. We got one heck of a deal. Now, I suspect that economic advantage is going to disappear over the next 12 or 14 months, because as oil goes up, gas goes up, here comes the flippers, here comes the weak need players, but they muddy the water, and that's going to drive prices up. But honestly, I think the $500 billion mineral market gives you and I and long-term investors 10, 20 years of just working different basins, finding those really good valued minerals. So it's not like there's going to be a shortage of supply. It's all going to be economically driven.
So as far as if I make an investment with you, and obviously we discussed the lack of liquidity with DSTs, if I want to sell just a piece of my stake, not a problem.
You want to.
So really, I sort of look at, for example, an UPREIT. For people, watching an UPREIT, basically, you cannot exchange into a REIT. You can exchange into a property the REIT absorbs. It's called an UPREIT. And I sort of look at those as the ultimate installment sale, but really this is not much different. I mean, you can buy into the thing and then you just sell pieces of it as you choose to. And if, for example, as we said earlier today, it appears that 1031 is safe, at least at this point in time, with a tax reform. But with that proposed 500,000 cap, it would be possible. And you mentioned numbers, a couple of million. People go into your deal. I mean, they could literally take and defer everything at this point in time. If they did ever put a limit on 1031 deferral, you've got the ability to take pieces of this and get rid of it. So you reduce your gain to a limit that was within what they put forth, obviously.
Exactly.
So that's an interesting thing.
I'll give you an example of that. So in some cases, we bought minerals 2 years ago where we knew the oil company was going to drill 5 or 6 brand new wells. Some of those portfolios have done over 30% rate of return, and that was at last year's $45 oil. So what we're now looking at is some of that low-hanging fruit, saying, we paid $11,000 an acre last March. We've already made 30% on the money. I bet we might be able to go sell those minerals for 18 to 24,000 now. So in 18 months, we can make 1.5, 2 times our money. That makes a pretty substantial yield. Here's what I've always experienced, and it's funny, but it's the way life is, right? Everybody's always looking for the angle. So if I go to my partners right now and say, hey, we got to sell that property I just described, when I sell it now, they're like, what do you know that we don't know? It's probably worth 3 times. Troy, you don't know what you're talking about. It may be worth 4 times. I'm like, well, you trusted me to get in, but now you think I'm tricking you getting out. So I've experienced where, you get these type A accredited investors, no matter where the resource their capital is. Some will never sell their minerals because it's so hands off, they'll just pass on their kids and grandkids. Some are looking at this as a 3 to 4 year hold, and redeploy capital. But like you said, some are saying, well, let me go through my portfolio. And yeah, Troy, I do agree to sell a third, but I want to sell a third of these 6 portfolios, but I don't want to sell any of these other. That's a very, very good decision-making process. So the way it would work, I would send you a list of all the mineral portfolios you're in, and underneath each one of those lists would be all the different mineral tracks that are in each portfolio. Our engineering firm would give a dollar value on a very static, fair basis across the board. In other words, they're all using the same metrics for valuation. And I'm going to say, Troy's selling a third of his portfolio in the following 25 out of 50 portfolios. And you're going to come back and say, Sounds good, Troy. I want to sell 50% of the first 10, 10% of the next 5, and none of the last third, because it is acre by acre selection process. Net oil and gas minerals are sold by net acre. So literally, if you owned 100 acres, you sell 1 acre, 5 acres, 50 acres, and however you choose to do it. That is the beautiful part about minerals, is that it is not in a cluster. I'm not tied to an organization. I'm not tied to management. It is literally, I'm managing my minerals as I see fit, which is a great, great advantage for 1031, self-directed IRA, or anything else.
That's great. So I want to hit. So we talked about, my people coming in via self-directed accounts, but I want to stress, you made a comment. So your product's available. It's on a platform that would allow people with just Wall Street IRAs and 401ks to buy into it. So I want to get that out to everybody. Troy,
you can't use a non-SIDRA though. You got to use a self-directed IRA because it's not a public security. And the normal traditional custodians of regular IRAs, they're too lazy to do the work on it. So you got to go through a SIDRA account.
Okay, so that's what I just wanted to clarify, because you made a comment. I thought you'd said that it went through the traditional Wall Street, and I hate to use the word traditional, but the Wall Street brokerage community, where we're not looking at that. We're looking at self-directed accounts, custodians, checkbook IRAs, solo 401ks, all those obviously we're going to be able to use to get into your product.
Yeah, it has blown me away. In our entire 36 years of being in the space, we've never realized the amount of magnitude of the depth of people interested in doing self-directed IRAs. 75% of our business in the last 3 years has come from self-directed IRA capital.
Wow.
75%.
Wow.
Now the 1031 is caught on, and we've got a pipeline of 1031s where people are getting the money to a QI. And that's one thing I should also tell you. So let's say you are selling a property headed toward a potential 1031, and you're looking for that exchange denotation, what you're going to exchange the asset for. If you give us advance notice and say, look, I've got a $500,000 1031, we're going to say to you, when do you think you'll close? When will it hit the QI? But more importantly is, what do you want from it? Do you want growth? Do you want income? Do you want 60%? Because then we can cherry pick or select the minerals that are either front loaded with higher income, if that's what you want, or they can be back loaded with growth, meaning that the wells will be drilled next year in 2023. So what happens for us is, because we have that time lag, we can selectively put aside the dollar amount of minerals that you need based on that configuration. It allows perfect timing for describing what you're going to buy, when you're going to buy, and how that portfolio looks. And our clients are loving the fact that they can kind of design their own strategy based on just picking and choosing minerals that we have in our portfolio.
So I want to stress what he just said there. I mean, you're not looking at just diversification into this asset type and maybe a geographical location of this type, but you're able to dictate what type of ROI you're looking at. So you can diversify, whether it's appreciation, income, so on and so forth. That's wonderful.
Yeah, I have an engineer as a client who doesn't want to pay. He doesn't want to buy anything with short-term income because he's fully confident last year that oil and gas prices were going to be substantially higher. He said, I want no short-term income. So he backloaded everything with growth. The flip side is, I had a partner coming in saying, look, I'm giving up a lot of income in real estate. I want that same income. So he went into minerals that already had 4, 5, 6 wells coming online as soon as we acquired it. But his cash flow is running 15, 18% a year. He's happy as a clam. So what we try to do in getting a relationship started, understand what the investor's needing and wanting, both from where the source of capital is coming from, but also what their long-term vision is. Because if we think we're headed into higher taxes, well, I may not be interested in selling because I don't want to pay higher capital gains tax. But I also know that if I'm going to be paying higher 1099 or federal income tax, I may want a little bit of growth added onto my portfolio today than I did last year, because I don't want to pay the taxes that are coming up. And then last but not least, and you know this, we use our drilling that we participate in to offset the gains, because we get 100% tax write-off for any wells that we drill. Wow. Because of what Trump put into place in 2017. So right now we've got over $10 million of requests from investors saying, I need write-offs in 2021. We've already done, I don't know, a couple $1 million so far. We'll place that 10 million. Every single dollar written will be 100% a reduction in your federal income tax. So that's pretty, and he's talking about removing that next year. So some of my guys are actually doubling their investment to carry the losses forward for 2 years, just kind of staging some losses they may think they need next year.
So you're talking about people moving through stuff. What's a floor of investment? I mean, what's the minimum that you take?
25,000 $25,000.
Wow, 25,000. I was thinking it'd probably be more than that. And then as far as what's the average hold for people? I mean, they typically they're buying in, they just keep the stuff, or I mean, do people sort of move in and move out?
We're hoping that the partners follow me as the dance lead. And what I'm telling them is, don't do this with any less than a 3-year hold, because it's like having a pecan orchard. Right now, we're buying seedlings and saplings. It takes a couple of years till they get a canopy. It takes a couple of years for the wells to get fully drilled online. We're starting to recognize the cash flow, but every single mineral acre we're buying is like buying a pen of pregnant rabbits. It has a well on it, 2 wells on it, but we know that the reservoirs, there's 2 or 3 reservoirs, and we know that there's going to be 3, 4, 5. Some of these particular mineral blocks have 8 to 24 wells on it. So we know that when we buy it, the only reason why we're buying it is we expect a lot higher density drilling and exploration over the next 24 months. So this is one of those, if you kind of think about exiting too early, you're gonna be like your dad described, or your grandfather described, where you sold way too darn early and you own Pebble Beach, right? Yeah. This is one of those cases where we think over the next 24 to 36 months is when we see the real value lift, because as commodity prices go up, this is weird, but the amount of reserves you have go up. And you say, why would that be? Well, if there's 50 million barrels of oil in place, today's technology says there's only 5 million barrels that we can get out in today's economy of scale. But if oil goes from $70 to $100 a barrel, we can probably pick up another 1 or 2 million barrels of oil. That means higher value in reserves, higher economics as far as cash flow. So now my overall value goes up based on cash flow and reserves. So what I know is that this 36-month period needs to be in their mind, so they let these saplings actually start providing some kind of commercial yield.
So as far, I mean, I don't think anyone out there is going to question that we're on some form of a bubble right now, the real estate world, right? I mean, it's just absolute craziness. So, and if you look at Wall Street, I mean, where are we with Wall Street? We're all-time record highs there as well. And meanwhile, we're talking about printing all this, well, we are printing all this money, everything going on. So in recessionary times, because I mean, it obviously you want hard assets. We're talking about what this is, hard asset. So in recessionary times, for example, if we go back 07, 08, what happened in this space, and you know, if we don't study history, we're condemned to relive it, right? So in recessionary times, your market gives stability. What to tell me about the profile?
Here's what happened in 08. So 08 was a global collapse. The dollar fell from 97 down to 79, which is what's going to happen to the dollar now. So dollar's hanging at 92 because we flooded it. We're the best of the worst in currency and fiat currency, right? Yeah. But oil prices went up to $145 a barrel, because when you're in a recession, you can't get your hands on capital. The fewer wells that are drilled, that means that the remaining oil and gas that's in place is going to be worth more money because I can't replace it. Remember, oil wells, the natural resource of hydrocarbons is different than gold and precious metals. Gold is gold. In my teeth, in my watch, it's always present. Every barrel we produce and consume is gone forever. So it's combustible. So the idea there is that if you have declining wells and no way to replace it, you know you're diminishing your daily production and you're diminishing reserves. Even in a recession, people still got to wipe their backside, brush their teeth, and drive a car, right? So the nice thing about it is that today, the capital has been cut off oil and gas because the financial backer said, you guys have drilled a lot of wells, put them online, pay down your debt. Boom, here comes COVID to Saudi Arabia, wiped them out. Now you're out of covenants with your loan. Now you have a federal administration trying to say, if you loan money to oil companies, or if you're a pension fund and give it to oil companies, we're going to move our pension money. They're deliberately cutting off the capital. Well, I love it. I mean, this is the best news. COVID, absent the human element of death and sickness, COVID's been the best thing I've ever seen, because that demand drop killed supply. That supply killed money. Both of those mean that nobody's going to replace the wells that I own. I'm looking at $150 oil in 24 months. I'm looking at $5.40 natural gas today, which is the highest it's been in 11 years. And they're talking about cutting off more oil wells and putting more constraints and taking away tax write-off. I encourage Biden, take away the tax write-off. There goes another 12% of drilling because investors won't invest without tax write-offs. Yeah. What I want to own as many producing wells as I can, because we're gonna have to get counseling. We're gonna have to go to counseling because our checks are gonna be so big. We're gonna feel so guilty. Our neighbors' electric bills are so high. We'll have to look like we're upset as we go to the bank and deposit those big checks. That's what I see happening.
Well, the oil prices, gas prices. I mean, I've got, we've talked about, I've got a big boat down sitting in San Diego. And it's one thing when you're filling a car with 20 gallons of fuel. It's another when you're filling a boat with hundreds or thousands of gallons of fuel, right? So, I mean, and the guys at the gas docks down there, it's like, well, hey, what's the price of oil? 10 cents a gallon more than last week. And yeah, I don't see any end to that. But, you know, something you commented, and if you combine, you know, what you're talking about, the strength in recessionary times, and you're also talking about the liquidity that you've got in this asset. I was just listening to you, thinking about, you know, this sort of state of the real estate world we're in right now. And we're in a great time to sell, a horrible time to buy stuff, right? And, you know, with 1031, you're looking at what's like kind, and we've all you know, established that your product is of like kind. And I'm just thinking out loud, thinking, well, gee, 6 months or a year from now, if we've had a collapse, you know, patient money is going to be golden, right? And but the thing is getting access to that money. So for people that can sell without realizing much gain right now and have patient money there, or, you know, self-directing accounts to be able to jump into that, that's one thing. But people completing exchanges, buying at the prices they are now, and then buying into something they're stuck with, that's problematic. So I was just listening to you thinking, well, gee, you know, it would appear to me it's a great opportunity to buy into your product, because in those times, the demand's not going to drop. It's probably going to increase. And so for my clients that want a place to park their money for a period of time, but they're wanting to take advantage of a bubble burst, correct me if I'm wrong, it sounds like your product's a place to go.
Yeah, it is. And I think, you know, look, I'm 57 years old. I feel like I've been doing this, you know, I'm going on 40 years, so I should be 80 or 90 years old, but I've listened very, very carefully over 36 years to the very smartest, wealthiest people I've run across. And that's some pretty smart people. And I think the real issue today, whether it be from 1031 or any form of capital you have, we haven't seen a bust since 2008. So we've kind of forgot what happens and how quickly it happens. I mean, I sat there in the summer of 2008, and my wife and I were talking about real estate. She says, you know, when will this bubble pop? It just can't go on forever. So this is a true story, and I'll make it quick. But I sat down with a client of mine who was a billionaire. We were about to do this big real estate project with condominiums. He's putting up all the cash. I'm a 50-50 partner. I get a free ride. He calls me to his office one day. And he says, hey, everything's entitled. We're ready to go. And he goes, I want you to answer a question for me. I'm sitting across with this guy worth $2 billion. He said, should we get going and build it? Or what do you think? I said, if you're asking me, should I put the money up and go forward? The answer is no. And he goes, why not? I said, because I think we're at the end of the rope. The bubble's too big. The margins are gone. We're taking too high a risk. I would not do it. And he hit his hand on the desk and he said, and that's why you're my partner. Then he took the next hour like Notre Dame and told me how the economy was going to implode, how everybody was going to be out, banks were going to fail, you couldn't borrow money from your mother, the whole 9 yards. And so I call that the bull elephant indicator. And the bull elephant is when the boys and the girls that really have huge net worths begin to move. You better pay attention and grab their tail and follow. So in my view, dealing with hundreds of millionaires every day and week, the bull elephant started moving before Christmas. They started moving back in October, November, before the election. And those bull elephants have pulled out of the stock market. That's why the stock market can't get above 35,000. They started pulling out of real estate, doing 1031 exchange, buying raw land where they can sit on it for 5 years and pay ag taxes, et cetera. So the problem today is nobody wants to leave the craps table in Vegas until somebody craps out. And by then you're gone. I've learned, because I deal in a risky business of drilling wells for 36 years, I've learned when that itch in your palm or the back of your neck starts, it's not that you got poison ivy. It means your gut instinct says, this has been a fun ride, but I better scrape some money off, leave a little money on the table that may be future gains, but it's better than losing the 20, 30, 40, 100% I made over the last 7 years. I see a lot of our investors today right now are doing that. They're moving as fast as they can. They're not quite the bull elephant, but they know where the bull elephant went and why. And they're scrambling. I mean, they are scrambling. So if you don't think the stock market or real estate is affected by the top 1%, that's really who controls all the markets. And they are moving. It's the millennials and the GameStop and all that kind of nonsense. Those guys are going to kill the market, because when their margins are called, they won't meet their margin. They're going to be forced to sell the rest of their stock to meet that margin. We could see an enormous drop off or sell off in the stock market, because most of the investors in the stock market have never seen a crash.
Yeah. And so, a couple of our biggest failures during the last crash were guys that had never seen a bad day. So, yeah, I mean, if you haven't been through it, and that's where, people going into, for example, the DST space right now, I'm just telling our clients, is look, if they weren't in business pre-crash last time, don't invest with them, because you just don't know, right? Until you know, it's a problematic deal. So, Troy, I just love, I love the story.
Nose for a reason, David. My nose is crooked because twice I started the fight with a guy bigger than me. I didn't do it a third time.
Yeah, I always joke. I'm always happy to learn and getting tired of being taught, right? We only get so many kicks to the head. So as we get older, we hopefully get a little bit smarter in that space. But Troy, I love the analogies. I've had you here for an hour now, and I don't want to take much more of your time. So as far as we sort of ran through all the questions I had for you, as far as just things, I'm jokingly say for the good of the order, things that you feel are important for the general public to know going into your product, as far as if somebody wants to learn more, I'm sure you're available to talk to them. Why don't you explain a little bit what's best way to go forward if they want information, how to do it, how to reach you, and then I'd like to. I'm just going to put it out there. I think I run all the programs for our CCIM Certified Commercial Investment Member for Oregon and Southwest Washington. I'll probably try to get you in there to speak to that group too, because obviously we have lots of people giving up real property, looking for places to go, and I think this is a great option. And I did have somebody come in talk about wind power, green energy stuff, which I like this stuff a lot better. But anyway, so any good comments?
Yeah, the main thing to understand is that I'm a family office. I've got my son here as an engineer. I've got my two son-in-laws with the company. We're a very family-oriented company. That doesn't mean a whole lot to most of you, but the reason I say that is we understand one thing: our partners are our number one asset. So we don't call you a client, we call you a partner, because we listen to you. We have feedback, what we're doing right and wrong. We look at everything we do from the standpoint of what's in the best interest of our partners. I am a very, very hands-on individual. So my cell phone number is 469-422-1781. Literally, you can call me about 20 hours a day. I don't get much sleep. I don't need much sleep. I love what I do. I'm excited about what I do. I have coming pretty soon 8 grandkids, and I've got son-in-laws and daughter-in-laws. I've been married for 36 years. I'm an overachiever. But the reason I point that out is that you can get hold of us on our website, which is eckardenterprises.com or elaminerals.com. You can call the 800 number and get hold of us. But here's what I do. I've got about 4 wealth managers on staff. They're not salesmen. They're not commissioned. They handle wealth on behalf of our high net worth clients. And what they'll do is sit down and discuss what you're trying to get done and why and how. We find that we are way, way under pressure. We don't care when you invest. What we care about is that you're educated. So if you go to our website and you start looking, I've done hundreds of videos educating, because here's the reality. Oil and gas is difficult. There's not a single site you can get 99% of the information you want. And there are a lot of sharks in the water. So don't listen to that Texas twang and that good story. Trust me, 9.5 out of 10 have no intention of making you money but skinning you alive. So these types of Zooms, working with these types of presentations, is all about putting the people, the whites of their eyes in front of you. Then you've got to do a little homework and make sure you know who you're doing business with. And the reality of it is common sense must prevail. So contact me at 800-527-8895. Call my cell phone, text me. I am very close friends with the majority of my clients because we go hunting together, we do things together, but I do it because I want them to know I don't carry notepad. I have a very crummy memory when it goes beyond a day. So I just tell you like it is factually, and you know exactly what I stand for, because at the end of the day, I don't know how to lie because it's not worth my time. I'd rather just tell you like it is. I'd rather just do a great job.
Well, Troy, thank you so much for the time today. I always really enjoy speaking with you. It's just a pleasure, and I've learned a lot. And I just want to put out there, our audience, the only dumb question is the one you don't ask. So, and as Troy said, this video, we try to get information out there just for our investors. I don't, if I send Troy somebody, I'm not getting anything out of it. I just want people to know what options are out there. I want to let them know they've got great resources for this. And I want, once again, to reiterate what Troy said. this video is an introduction to this topic, and hopefully it answers some of the questions that might be first and foremost in your mind. But take advantage of Troy, his website. Take a look at what else, other information he's got out there. The video presence in this world today is a wonderful thing. I think so many of our people out there learn so much by, seeing what they've got, and then they get to a comfort level to pick up the phone. But don't hesitate to pick up the phone and call them. You're going to be talking to real people. You're not going to be sitting in a queue waiting to get a hold of somebody. So as Troy said, you got his phone number. But if you can't, if you need something, reach out to me, reach out to Troy. I think this is a great opportunity for people, another place to put your money and just diversify. And it's just one of those things for our IRA 401k people. I want to stress, you're going to need a self-directed account to get into this stuff. We obviously can take care of you for that, whether it's a basic account, checkbook, IRA, or 401k plan. But we can get you in touch with him. He can take your money for qualified money and via 1031. And you're just going to let him know what the source is, your timelines, like he said, what kind of money you're going to need. And I just want to stress once again, these are unleveraged investments. So if you're coming out of a property with some debt, you've got a choice. You either pay tax on that spread or just add money offsetting the debt relief, and you're going to be just fine. So Troy, thank you so much for joining us today. All my best. I look forward to seeing you. And I do want to fly around in the helicopters and play like we talked about. So
sounds good, my friend. I appreciate it. You have a great weekend.
Yeah, you as well. It's been a pleasure. Thank you. And we'll look forward to talking again soon. David Moore, Equity Advantage, 1031exchange.com with Troy Eckard, Eckard Enterprises. And we look forward to talking to you soon. Thank you. Bye-bye.